Philly, since you're here at Post 9, why don't we start with you? We've seen a pullback in oil prices. We've seen equities make some recovery today. Do you think that tomorrow, if we get this release from these strategic reserves from G7 nations, does that create a positive tailwind for the market? Or is the overhang of an extended war, does that still kind of loom over investors?
Yeah, for me, which I said it from the beginning, I really believe it's the duration of the war. It's what's going to matter most, right? So the longer the duration, the longer the issues in the Straits of Hormuz, the higher the price of oil goes, which will create economic issues. I don't know how much the release of the strategic reserves is going to make the overall markets. Maybe in the short term, maybe it's what you're seeing today. But Frank, at the end of the day, in the long term, it's for me, if it's the longer duration of this war, the more issues we're going to have with the price of oil and the volatility we'll have in markets in general.
All right, we're certainly seeing volatility lessened a bit today. We saw the VIX pull back a bit. We keep hearing people say, whether it's our reporters or other guests, ever since. It's the biggest spike since this time. It's the biggest spike since that time. So clearly we're talking a lot about disruption. It's what you're looking at as well. You actually see a 10 to 20% drawdown in the markets coming up this year. Is it from this oil disruption? Is it from something else? What are you seeing?
Yeah, so I've been pretty clear coming into this year. There's a couple of things that I've been looking at of why I believe there could be some volatility where you could see a 10 to 20% correction. Number one is anytime you have a new Fed chair, especially Kevin Warsh, which is interesting because he's looking to bring the Fed balance sheet, I believe, down to mute inflation and bring interest rates down. With that, you're going to see volatility around that with markets. Historically, you've seen a correction around 14%. Typically, second year of mid-cycle with presidential mid-cycle with midterms, you get a correction, you get some volatility around there. And obviously with geopolitical unrest like we're seeing, you also get volatility. So when you put those three things together, coming off two back-to-back years of a great, strong markets overall, that's where I think you see some volatility of around 10 to 20% downside.
So you're seeing some volatility, but you also see some opportunity.
Absolutely.
Give us a couple of picks. Now, this one I thought was interesting.
Right.
Uber. Mm-hmm. A lot of that business is discretionary. Right. What are you seeing? Of course, some of it you just have to get where you're going, but a lot's discretionary. Why are you seeing Uber as a stock to play here, impacted by higher gas prices, impacted by consumer spending as well?
Yeah, so overall Uber is a business, reminds me of like Google with search with ChatGPT, where people re-rated Google to a lower price. It was a great opportunity. We took advantage of that. We did really well. Same thing with software, with CRM right now. You've seen the software sector get hit because of Anthropic. I think Uber's like that with autonomous vehicle. That's why you're seeing it get re-rated to a level of a forward multiple of 21 times. But the reality is that Uber has done a great job under the current CEO. It's a margin expansion story. It's a free cash flow generation expansion story. Top line revenue up 20%, bookings up 22% year over year. It's turned into a great, mature business that I think will actually do well under autonomous vehicle. They've done a partnership with NVIDIA, other OEMs, and I think their network of 200 million people per month, I just think it's a great business that you could do well over time. And it's re-rated at a price where it makes sense.